Imagine you have two friends, John and Mike. John is a millionaire, while Mike is always struggling to make ends meet. You wonder, what sets John apart from Mike? How did John become rich while Mike is still struggling? The answer lies in the decisions they made. Rich people think and act differently when it comes to money. They invest their money wisely, avoiding common investing mistakes that many people make. In this video, we'll be discussing some of the investing mistakes to avoid, such as common beginner investing mistakes and stocks that the rich don't make to help you refrain from them too. But before diving into more about that, let me first welcome you aboard for this episode of Finance Arc. On this channel, we set sail on a journey into the vast realm of financial matters, where we guide you through every step of the process and assist you in navigating the challenging world of finance, from simple budgeting advice to more advanced investing strategies. So grab your life vest and get aboard the Finance Arc. Let's talk about one of the biggest mistakes that people make when it comes to investing: failing to diversify. Imagine you're at a casino and you're trying to win big at the roulette table. You decide to bet all of your chips on just one number because you have a hunch that it's going to hit. What are the chances of winning big? Pretty slim, right? Well, the same goes for investing. Investing all your money into one stock or industry is like betting all your chips on one number at a roulette table. It's a huge risk that could lead to losing everything if the stock or industry takes a hit. Diversifying your portfolio by investing in different asset classes and industries is crucial to mitigating risks and potentially maximizing returns. The collapse of Enron in the early 2000s is a prime example of the importance of diversification in protecting your investments. To invest like the wealthy, remember not to time the market and instead focus on long-term investing and diversification. Just like spreading your bets at the roulette table, spreading your investments increases your chances of winning. Timing the market. Imagine you're playing a game of whack-a-mole. The moles keep popping up at different speeds and in different places, and your goal is to hit as many as possible before time runs out. Now imagine trying to predict exactly when and where each mole will pop up. Sounds pretty difficult, right? Well, that's kind of like trying to time the stock market. It's virtually impossible to consistently predict market movements. The wealthy understand this and don't waste their time and energy trying to time the market. Instead, they focus on long-term investing and hold their investments for years or even decades. By taking a long-term approach, they're able to ride out short-term market fluctuations and benefit from the overall growth of the market over time. It's like playing a game of whack-a-mole where you're not trying to hit every mole, but instead you're focused on hitting as many as possible over a longer period of time. Let's take a look at a real-life example. In the early 2000s, many people were investing heavily in tech stocks, convinced that the tech boom would continue indefinitely. However, when the dot-com bubble burst in 2001, many of these investors lost everything. The wealthy investors who didn't try to time the market and instead held a diversified portfolio of stocks, bonds, and other assets were better protected from the fallout of the tech bubble. Overreacting to short-term market volatility. Investing in the stock market can be volatile and unpredictable, and the wealthy understand that overreacting to short-term market fluctuations is not a sound investment strategy. They remain committed to their long-term investment plans and don't panic when the market experiences short-term fluctuations. The advantages of this approach are that it allows investors to avoid knee-jerk reactions that could harm their portfolios, and to focus on their overall investment goals. One example of this is the 2008 financial crisis, which caused many investors to panic and sell their stocks at a loss. However, those who remained committed to their long-term investment plans were able to recover from the crisis and potentially see significant returns in the years that followed. Not doing enough research. Imagine you're a lion and you're planning to hunt for your next meal. Do you just randomly chase after any animal you see, hoping to catch it? Of course not. You spend time studying your prey, learning their movements and figuring out the best approach to take them down. Well, the same goes for investing. If you don't do your research before investing, you're essentially just blindly chasing potential gains. The wealthy invest time and resources into researching their investment options instead of relying solely on hot tips or advice from others. By conducting through research, they are better informed to make smart investment decisions. This strategy helps them avoid potential pitfalls and maximizes their returns. For example, by investing in a company that has a solid track record, the wealthy can benefit from long-term growth potential and avoid risky investments that could result in losses. Letting emotions drive investment decisions. Picture this: you wake up one morning and check your investment portfolio, only to see that one of your stocks has taken a dip. Your heart starts racing and you begin to panic. Should you sell now before it drops even further, or should you hold on and hope it bounces back? This is a common scenario for many investors, and it's where emotions can start to cloud judgment. But the wealthy don't let fear drive their investment decisions. They understand that short-term market fluctuations are a normal part of investing and remain committed to their long-term strategies. Investing based on emotions can lead to irrational decisions. The wealthy understand this and make investment decisions based on research, data, and a long-term outlook. By removing emotions from the equation, they are able to make logical and rational decisions that are more likely to result in long-term success. This approach allows them to avoid making impulsive decisions based on fear or greed, which can lead to costly mistakes. Focusing too much on short-term gains. Warren Buffett, the CEO of Berkshire Hathaway and one of the wealthiest people in the world, has built his wealth through long-term investing. His philosophy is to invest in companies with strong fundamentals and hold on to those investments for years, even decades. One of his most notable investments is in Coca-Cola, where the Berkshire Hathaway invested $1.02 billion in 1988, which at the time was the largest investment in Coca-Cola's history. Despite market volatility over the years, Berkshire Hathaway continued to hold on to its Coca-Cola investment, resulting in a return of over 2,000% on its initial investment, currently worth over $22 billion. This serves as a perfect example of how prioritizing long-term growth over short-term gains can lead to significant returns over time. By following Warren Buffett's investment philosophy, every day investors can also potentially achieve financial success through wise investment decisions. Investing can be overwhelming, but it doesn't have to be. Don't let fear or uncertainty hold you back. With these tips in mind, you can be on your way to achieving financial freedom and becoming the next millionaire that others look up to. Are you ready to take control of your finances? Subscribe to our channel for more tips on savings and investments. Don't forget to turn on notifications so you never miss a new video. Let's grow our wealth together. Stay tuned.